The Nifty opens at a fresh life high for the third straight day. Although indices give up majority of the opening gains, metals and realty surge while IT and consumer durables lag. It's the mid caps which are outperforming today.
Gland Pharma enters into an agreement to acquire CDMO player, that's Sensex Group, for around 120 million euros. The company says that there is no communication of the parent person's possible stake sale in the company. The stock is lower though, as the acquired asset is margin dilutive.
The Inox Group cuts debt across all businesses. Inox Green repays 250 crores. Inox Wind pays 161 crores. The group also says further debt reduction is underway in both the companies.
Big block seen in Zomato, 3.5% equity change hands at an average price of around 64 rupees per share, with Alibaba likely to have sold part of its stake in the company. Hello and welcome to Chartbusters. I'm Nigel D'Souza and joining me is Mangalam Malu. Well, Mangalam, it seems that the markets are facing some bit of resistance at around that 18,700 odd mark. And, earlier today we made that point that maybe we could brace ourselves for a bit of consolidation and maybe some mild correction as well. And from the day's high, actually, we have come off. The Nifty Bank, well, that's moved into the red already as we speak. The IT index as well, that's trading in the red. So both the pillars of the markets are under some pressure. Let's see how things move. But if you want to pick up a bright spot, I guess it'll have to be the broader market performance. You still have more number of stocks that are advancing than declining. But at the end of the day, we'll have to track that and see whether this can be maintained. We have to, Nigel, and that really is the story of the day. More number, way more number. We have almost 1,900 stocks which are in the green for about 900 which are in the red. But, towards the end of yesterday's trading session, this number actually moved in favor of decline. So this is something we will monitor even as we consolidate around the frontline spaces. We do have a bunch of cash stocks which are doing extremely well. Five Star Finance, of course, reported numbers, a big move on there. That stocks moved to the high point of trade. We had the management here on CNBC-TV18 as well. Kalyan Jewelers, Lemon Tree Hotels, all of them are actually buzzing around. TCPL Packaging is the other one, which is up about 39% this month itself. So big movers in the small and mid cap space. But what can we say about the index, which is currently consolidating? Let's welcome Ashish Kyal. Ashish, your thoughts? I mean, we have been notching record highs, but it's been more of a buy and hold market than, trade the intraday market sort of thing.
Hey Mangalam, morning to you and all the viewers. Yes, absolutely. See, the overall trend for the market is positive. That is what we can say. And it's a buy on dips market. So someone who is trying to catch a breakout, you can see that it goes up and then consolidates or shows some kind of a dip. That is what we saw even in the final hour yesterday. But the overall sign is very healthy as of now because we are seeing a rotational buying. It was PSU banks which started the rally. Then we saw the Reliance, the big boys catching up, Reliance catching up. Then we saw HUL catching up. And today the metals and auto sector is showing some positive signs. So it's a rotational rally, which is a healthy sign so far. Mid cap and small cap indices has a lot of catch up to do. They are still, I think, down by around 10, 15, 20% from the lifetime high levels. Having said that, I would be buying this market. I would use dip towards the level of 18,590, 18,580 as a buying opportunity for the target of around 18,800 on the upside, where there is again resistance level as well. As long as 18,500 remains intact on the downside. So this is buy on dip. I would not buy the breakout. I'll buy the dip.
Oh. Okay, all right. Thanks a lot, Ashish, for stopping by and filling us in with your take on the index. But let's shift focus, I think, to our special segment where we get you a few ideas for profit from Money Control Pro. Jitendra Gupta, moneycontrol.com, joins us to talk about a stock that is tracking rather closely. Jitendra?
Hi, thanks. We have been recommending Watec Wabak, the engineering company in the water treatment space, from the levels of around 225 in June this year. And even at current levels, it is trading at 8 times its 1 year forward estimated earnings, and it continues to offer good value on the back of significant improvement in fundamentals and, of course, a strong order pipeline. It has orders of worth about rupees 10,000 crore in hand, which are close to 3.4 times its annual revenue. While current order book provides a greater visibility, the notable point is that the execution has picked up, particularly in the international market with the easing supply chain issues. In the quarter ended September 22, we saw a good traction in industrial and EPC business, which delivered a strong 76% year-on-year growth, held by higher execution. The second half of the current fiscal should be even better, both in terms of margins and scale. The Russian project has started awarding, and if you see the awarding of rupees 6,000 crore Chennai water project is expected anytime soon. So overall, the order pipeline remains same, very good, and the scale is expected to improve. Margins which were depressed are now set to expand, helping it deliver higher earnings growth. Lower commodity prices and changing revenue mix towards high margin businesses are going to support higher earnings as the scale grows.
All right.
Welcome back. Well, winters are upon us, and one company that traditionally had a larger exposure actually to the winters was Monte Carlo. They have de-risked their portfolio a little bit, but to understand how this business is shaping up, we're joined by Mr. Sandeep Jain, the Executive Director of the company. Hi, Mr. Jain. Thanks so much for joining in. Well, one factor that the street was disappointed on in the second quarter was your revenue growth was only 5%. Now, you've been guiding for the growth of close to 25% for the year. So first up, tell us, why did you grow by only 5% in the second quarter? And do you stick to that guidance of 25% for the year? Go ahead, Sandeep.
Yeah, thank you, Nigel. So whenever we give our guidance, we give our annual guidance because there are quarter-to-quarter variations depending upon the festivities, depending upon the festive season, depending upon the start of winter season. So overall, the guidance remains same, but there can be quarter-to-quarter variations.
So you are confident of 25% growth. I mean, the first half you grew at 29%. The second half usually is a much stronger quarter for much stronger period for you. The third quarter, of course, accounts for majority of your revenues. So is there a chance that you can actually outbeat this 25%? It's getting colder.
As of now, we are sticking to our previous guidance of 20 to 25%. But as the season goes ahead, we see November and December and January. So if the demand has been very good, we can revise our guidance also.
What have the early trends been in terms of demand? And also, the second quarter, I presume you would have exhausted a lot of your high cost inventory. Since then, we've seen some reduction in input prices as well. So how has that panned out for you?
See, season has begun well. And as far as there are three factors for that. One was as there is no restriction this year after the COVID, so everybody was going for revenge shopping. And secondly, weddings have started in a big way in northern India as well. And there are even parties are happening and the winter is on time. So all these three factors are favorable for us. And we are very hopeful of achieving our guidance. And I think we'll be maintaining our margins as well.
Maintaining margins of what, around 18 to 20%?
We have given a band of around 21% EBITDA plus minus 100%. So we'll be maintaining that.
So around 20, 21%. Got that. So I wanted to ask you about the company-owned EBOs. That will give us a better sense about demand because you're realizing, the sales immediately as it happens. Give us a sense if you have to compare 2022 winters with 2019 winters, particularly in this segment. That's the company-owned EBOs. How much better is it?
See, 2019, pre-COVID, we are far ahead for that because last year we grew around 45%. So we are far ahead as far as pre-COVID level sales are concerned. Even we are growing from the last year's sales also. But the exact data is not available with us because we get the data only, once we have October, November, December, all the 3 months are realized. But we are hopeful that we'll be growing around 20-25% as compared to last fiscal.
Sandeep, I'm just trying to understand particularly about this segment. That's the company-owned EBOs. You're saying that the sales even this year will be better than last year and better than 2019 as well, right?
Yes, of course.
Okay.
All right, we take that point. What about ad expenses? Because in the second quarter, while your gross margins improved by 400 basis points, I presume that was on account of, easing in raw material prices, etc. as well, and you realizing a lot more for your sales. You spent a lot more on advertising. Was this a one-off ahead of the third quarter, or is this likely to be the run rate going forward? Because in the second quarter itself, you spent about 5% of your sales on advertising.
See, I'll explain. See, what happens before COVID, we were spending 3 to 4% of our advertising cost.
Right.
And once in COVID, we started only 1 to 2%. But now we have given the guidance of 2 to 3% of advertising cost. So in second quarter, it has gone, very high. But in third quarter and fourth quarter, it will average out. So overall guidance will remain same at 2 to 3% as far as full fiscal is concerned.
Okay. All right. Sandeep, the other factor is, input costs have cooled off. Whether I see it on yarn, cotton, and that will be beneficial for you. But you'll be sitting on some inventory. So from which quarter onwards will we start realizing this benefit? Some part of quarter 4 or quarter 1, or what is it?
See, normally when the input cost goes down, it takes 6 months to
6 months.
get the benefit of that.
Okay.
So if it has now gone down, so you'll be realizing it in first quarter of next fiscal.
Okay, first quarter of next week. So we'll talk about margins then about the next year. But, you have been veering away from woolens as well. I remember summer, being just about 35% of your sales, you wanting to take it to around 45% of your sales as well. But also wanted to understand about home textiles, because you had a couple of plans in terms of increasing blankets capacity, etc. Accounts for about 20-25% of your sales currently. How much is it likely to be going forward?
I think we are very bullish on home textile segment, as it has been growing around 30-35% per annum. And this year we hope to close around 160 crores of home textile sales. So as we have announced earlier, also we are coming up with the blanket manufacturing plant at J&K in their central government's policy.
Okay.
So that plant, we think that would be operational in the third quarter of next financial year, and that will again add to our revenues.
Okay.
So we are confident of growing 30-35% this financial year in home textile, and the growth will be more when the plant will be operational.
Right, and in FY24 you'll have the benefit of this new plant J&K, and you are putting in 80 crores, right, in this unit?
Yeah, around 80 to 100 crore.
At optimal levels, what kind of sales can you realize?
See, some of the sales, some of the production will be used in-house, as already we are outsourcing it, and rest will be selling it in the market. So additional component of sales which will add to our revenue should be around 70 to 75 crores. 70 to 75
crores. All right, and this entire unit is for home textiles itself?
Yeah, it's for home textiles.
All right, it's been good speaking to you, Sandeep. Thanks so much for stopping by. You're looking reasonably optimistic about business from here on. 20 to 25% growth in terms of revenues. Home textile, that'll grow at a faster clip, and margins in the vicinity of around 20 to around 21%. On the back of that positive commentary, seeing a bit of an uptick on the stock. Remember, post quarter 2, the street was a little bit disappointed that the revenue growth was only around 5%. But as the management clarified, we need to look at it on an annual basis, and they're confident on meeting their guidance. For the time being, we'll slip into a short break. On the other side, we'll get you excerpts from our exclusive conversation we had with the outgoing Revenue Secretary, Tarun Bajaj.
We had an exclusive conversation yesterday, an important one that too. Outgoing Revenue Secretary Tarun Bajaj saying that he's confident that the government will meet the 6.5%, 6.4% to be precise, fiscal deficit target this year. Let's hear him out.
We had done some preparation. Now it will depend on the policy makers. I'm not involved in the budget making process, so it will depend on whether they want to bring it or they want to wait a little more, do more conversation and more discussions and debate on it. But yes, one thing is for sure, that our capital gains tax regime is very complicated. It needs simplification. I've said it earlier and I'm repeating it here, that we have various buckets under which we put all products. Financial also we put in different buckets, and then we charge different taxes on them as capital gains. Then we also have different time periods to decide short-term and long-term. Then in some cases we have indexation, in others we don't have indexation. So I think all this needs cleaning up, but whether the time is right now, the time maybe was yesterday, if I may say so. But whether it happens this year or not is something for us to see on the 1st of February.
Let me address an issue, a tax that was brought in given the global economic context as well as the need here domestically, the windfall gains tax. What we have seen now is crude prices coming off quite sharply, in fact at a 10-month low. While there was never an official number in terms of what is the threshold of when the government will decide to withdraw or roll back the windfall gains tax, the expectation or the assumption or the rumored number was $75. Can you explain to us where things currently stand, the thinking on the windfall gains tax?
So windfall gains tax is something that we've been changing every 2 weeks. I think the day we presented this, there was a lot of apprehension, including in the media, may I say that we will not change it and this is there for to stay. But within 14 days or 15 days, the first time we took a little more time, we changed it and it went up and down. And so I think as the prices come down, the windfall taxes will either reduce or they will go away. And as a policymaker in the Ministry of Finance in the North Block, I would say that if the windfall tax actually goes away, it's good for the economy, because that means that the crude prices are down, the diesel and petrol product prices are down. To that extent, our import bill reduces and our current account deficit improves. So if that happens, that is far, far better than the small amount of windfall taxes that we'll collect through this process.
Let's talk about the macros now, and I want to talk to you as far as the overall tax picture is concerned, and that's where the real cushion is coming, both as far as direct as well as indirect taxes are concerned. Of course, expenditure has also been higher on account of the food and fertilizer subsidy. How comfortable do you feel in terms of meeting the fiscal deficit target? There are, of course, estimates suggesting that we may, in fact, exceed on account of the higher expenditure. I want to get your view on where things currently stack up, both on the tax front as well as expenditure.
I can say that the government is feeling very confident that we'll meet our fiscal deficit target of 6.4 in spite of very heavy burden on account of food subsidy, fertilizer subsidy, petroleum subsidy also to some extent having come back. But I think the higher revenues and some other measures which the expenditure side would have taken would see us this year to 6.4. Last year also, I think we did 0.1% less and not more. So we have made a promise to the country that we'll take it to 4.5% in 25-26. I think in Ministry of Finance, all of us are very conscious of that and always are working on that. And I think the people of this country have also helped us by paying more taxes, so revenues have come, which will take care of the higher expenditure.
So you feel confident of being able to achieve that fiscal glide path that you have committed to?
So what I'll say is that 6.4 is something that I feel should happen this year. There's no reason even today that I feel that we would exceed that 6.4.
Particularly disinvestment. Of course, over the last budget, there has been an attempt to put in a much more realistic number, but even that so-called realistic number, the actual performance on the ground is far short of that. What do you think is the issue, and do you believe that once again there needs to be a relook at the way that the government is projecting both disinvestment as well as monetization? Because even as far as monetization is concerned, there is a wide gap between what the government had projected or estimated and where things currently stand on the ground.
Disinvestment, I would say this year's target is about 65,000, not about, it's 65,000 crores, and they are close to having achieved almost 30,000 or a little more. So let us see, there's still 4 months to go for the year to end. And there are some things in the offing. So I think the Disinvestment Ministry department would be close to the figure that they have projected in the budget. If it falls short or goes up by 5,000, 7,000, so that's not of so much of importance.
Well, on that note, we'll have to wrap up on this edition of Chartbusters with news that the Nifty is mildly holding onto the green, but the Nifty Bank is under some pressure. Trading up takes all the action forward.